can be relied upon. Still, in the world of accounting, there are some incentive problems. And I talked about this in the last class session when I talked about the fundamental problem in accounting. And I used as an example the corporate audit model for public companies. And that's a three-party model. Okay, with management hiring accountants to do audits. And those might be internal or external auditors. And this is in order to obtain financing. This is the rush thing that I did at the end of last class session. Management provides the auditors with information. This is an information arrow. That's an information arrow. The auditors then provide the financiers with information. And this provides the financiers with the knowledge that they need to know in order to trust that the company's financials are indeed as the company is representing them. Okay, and I suggested that most of the time this relationship works out in a morally upright way. The great majority of accountants that I personally have known have maintained a kind of an independent perspective as accountants. But because of the monetary relationships that are also present here, sometimes it doesn't work out. For instance, starting with the first monetary relationship that I mentioned last time, the financiers provide management with money. Management is seeking to obtain financing. This is to expand operations, to do research and development, to do whatever things they need to do with corporate financing. And this might be coming from equity financiers, it might be coming from credit financiers, but they're trying to obtain financing. And in order to obtain that financing, they employ the accountants to give the financiers a look at the company's books and to show the financiers that the company has a clean bill of health when it comes to its financials on its balance sheet or its cash flow statement or whatever. The second monetary relationship here then is this one between management and the accountants. And that's the problem that I mentioned last time, which is that management pays the accountants. And wherever money is flowing in business, that's where the influence is flowing as well. And management desires the auditors to complete a particular job so as to obtain financing. And to do that, management pays the auditors. The fact of the payment means the auditors are working as employees for management. That might just be as contract employees and not as permanent employees, but they're employees nonetheless. And this influences the accountants a lot of the time. Okay, the job of a good accountant is to be a referee, to call it like he sees it, to maintain some level of independence from management or from whoever the accounting job is being done for. But if management is paying the auditors, which is the arrangement structurally that we have right now, that always influences the auditors, even if only to a very small extent. It can be an influence that is resisted, often successfully resisted, but it is an influence that nonetheless happens. Okay, and I mentioned at the very end last time that there have been proposals for other kinds of payment systems. Regulators are an example of this. If government officials paid auditors, that might solve the problem of management, the teams paying the referees, like I mentioned that this was analogous to last time. This would be more like the league office paying the referees. But that hasn't caught on because government tends to be inefficient and wasteful, and also because regulators can be just as corrupt as management is. Financiers could pay the auditors, but they don't, because people don't want to pay transaction fees every time they buy or sell the stock of a company. Okay, so for better or for worse, this is the arrangement that we have right now. Now, I want to spend the balance of our time today talking about a couple of articles in Beyond Integrity and also using this relationship I've listed up here on the board to begin to unpack what's surely one of the, well, it is the biggest corporate scandal in American history, and that's the Enron scandal. Okay, we're going to be talking about Enron in our accounting ethics module over the next couple of class sessions. You can't look at Enron in just one day. It's such a big thing that it takes a little bit longer than that. Okay, but this all occurred actually in our fair city of Houston. We have here in Houston the biggest corporate scandal in American history in our history. So that's something I suppose we could be kind of notoriously proud of. Let's look at the Stewart article in the Beyond Integrity text on page 325. And I just want to highlight a couple things from this article. Are there any questions, by the way, about the accountability relation that I've put up here? That was just to get us all up to speed with the things I did at the very end of last class. Okay, Stewart is keen to emphasize that accounting is an interpretive art. It can take a variety of different forms. By the way, who are my accountants in today's class? I have no accountants in today's class. What are our majors? Major? Electrical. Oh, that's right. Yeah, that's fine. That's cool. That's cool. We're glad you're with us. I hope this class is interesting for you. Good. Major? International business. Major? A little louder.
Management.
That's right. You've told me.
Business.
Just business.
Marketing.
Marketing. Okay. So a bunch of management people. That's cool. Well, you guys will be employing the accountants, so you need to know what they're doing anyway. All right, on pages 326 and 327, Stewart concludes that accounting is actually an interpretive art. Okay, it involves a variety of different interpretive steps. And if you look at the top of the first column on page 327, Stewart writes, by surrounding individuals with norms and standards by which inefficiencies and wastes are rendered visible, a whole range of calculation programs and techniques come to dominate the life of the individual, and accounting becomes part of the network of power relations that are built into the very fabric of organizational life. So the accountant's role should not be seen as a merely technical one. The accountant is not an uncontested figure who reveals a pre-existing reality, a realm of fact, a realm of measurable efficiency. Okay, accounting is more like a photograph. It is taken from a particular vantage point with a particular lens at a particular time for a particular purpose. A little further down, it is the softness then of accounting numbers that is the reason why managers are so interested in them, for they can manipulate them where they may be motivated to do so. Okay, that's true to an extent. I agree with Stewart for sure. To an extent also, though, the numbers are what they are, and it's a realm of parameters within which accountants do have boundaries. They can't just go off-roading whenever they want to. But within the context of those boundaries, yes, accountants do have a lot of latitude to manipulate things in a particular way. Okay, how can they do that? Well, let's think about this for just a second. There are all sorts of different ledger items on various different corporate statements that accountants can manipulate and that can actually change in value in accordance with accounting interpretation. Okay, so what are the three corporate statements that all, at least public companies, have to provide the public with every year, according to SEC regulations? Do you guys know what those three corporate statements are?
Income statement.
Good.
Balance sheet.
Good.
And
Cash flow statement. Okay, income statement, the balance sheet, and the cash flow statement. And if you look at a balance sheet, what is typically practiced on a balance sheet, I think most of us have familiarity with what balance sheets look like. They are double book or double ledger in format. Okay, assets are tabulated and liabilities are as well. And underneath assets, there are all sorts of hard items, obviously material assets, property, plant, and equipment, things like that. are things that are hard to manipulate. Okay, although actually in Enron's case they did manipulate them, and I'll talk about how they did so in a moment. But others are soft items. Okay, so for instance, when a takeover occurs, often there's a premium that is paid by the company that's doing the takeover as opposed to the one that's being taken over, and that premium is called goodwill. Okay, and goodwill is a real fuzzy thing on a balance sheet. It's very interpretive. Okay, it's very difficult to determine precisely what constitutes goodwill. There are other kinds of assets that are often very intangible in nature. Okay, so assets come in tangible and intangible varieties, generally referring to the materiality of the asset. Okay, one example of an intangible asset might be a brand. So if you think, for instance, about some of the most powerful corporate brands, those brands are actually valuable. They serve as assets. Companies borrow against the brand, using the brand as collateral because it is a real asset. But it's also a very soft asset in the sense that it can be interpreted differently. Let me give you just an example of one of the most powerful brands. Disney, incredibly powerful stable of cartoon and real life characters in their movies over the years that have become iconic brand symbols for the company. Okay, we didn't pass out candy this last Halloween at my house, but every year since the movie has come out, when I have passed out Halloween, all the little girls come as Princess Elsa. Okay, this just happens every single year. Nobody ever wants to be the other girl. What's her name, Anna? Poor Anna. No one ever wants to be Anna. Everyone wants to be Princess Elsa, probably because they want to have the ability to do the magic. Okay, but this is a really powerful brand that Disney has. Probably nothing, in fact, outside of the Star Wars. Well, I take that back. Star Wars and Marvel are both owned by Disney. Okay, so maybe alongside Star Wars and Marvel, the Disney Princess stable is one of their most powerful branding elements. Very powerful. Lots of asset value there. How much? Well, it's an interpretive art to know precisely how much. And if Disney wants to borrow against it and use that brand as collateral, sometimes that can be difficult to actually nail down. Okay, let's look on page 333. I want to look at the Staubus article. Okay, the reason why accountants have come to play such an important referee role in contemporary business is because we live in a society of strangers. Okay, back in the day, when business was done often face-to-face, and when there was reputation involved, and reputation could make or break a business contract, accountants didn't have to play as much of an important role. But today, business is often done among strangers who have no reputational knowledge of each other at all. And so they rely upon intermediary parties, accountants, to serve as referees who can help guarantee the truthfulness of the counterparty that they're doing business with. Okay, and if you don't believe me, it very much matters that the counterparty be trustworthy when you do business. Recently, in this last week, there was a big blow up in a hedge fund style family office. Forget the name of it. Archegos, I think. Archegos Capital Management. Anyway, the company was running, or the hedge fund was running way too much leverage. And they had a blow up, and this actually ended up costing the investment banks that had lent them money billions of dollars. I think that it cost Nomura $2 billion. I think it cost Credit Suisse $4 billion. Deutsche Bank, Goldman Sachs, Morgan Stanley all suffered enormous losses. And I was reading a little bit about this case. It's a fascinating case. I noticed a little tidbit, and the dude who ran the hedge fund, Bill Wang, was considered so untrustworthy that Goldman, as recently as 2018, this is Goldman, one of the foxiest of all of the investment banks. Surely if there ever was a shrewd investment bank, it's Goldman. They refused to do business with him as recently as 2018. Not because they couldn't, they certainly could, but because they did not trust that the counterparty was telling the truth in their dealings with him. Okay, and again, that's Goldman, who doesn't have a very good reputation for truth-telling themselves. So if even they weren't willing to do business with him, he must have been very dishonest indeed. Okay, but if you look at the Staubas article, Staubas highlights this and says at the beginning of the article, the focus of this essay is on ethical lapses that contribute to the failure of corporate accountants and auditors to fulfill their responsibilities for financial reporting to investors. In the context of the decentralized economies that are widely believed to serve the interests and aspirations of citizens of democracies in the 21st century, the role of investors is an important one. Those are the financiers that I have up on the board here. Okay, success for absentee investors is critical to the continuing contribution of capital and capital markets to the welfare of those citizens. A little further down, when accountants, including auditors, fail to provide investors with reliable information that is relevant to their capital allocation decisions, investors and all citizens with stakes in the success of the economic system suffer. Okay, the essay then goes on to try to highlight a number of ethical lapses that have occurred in accounting in recent years, and to talk about what can be done about these lapses. Okay, but the point that I wanted to get out of that first part of the essay was just that accountants play a crucial role in providing financiers with reliable information, and this is especially crucial in a world that is globalized like ours, where business has to be done often among people who are strangers to each other. If you turn the page to page 339, this is after an article spent discussing reasons why auditors have fallen into ethical lapses, ethical failures, what can be done about it. On page 339, Staubas talks about ways to try to separate management from accountants. In other words, ways to try to increase the distance in this relationship here. The problem comes when the relationship becomes too chummy, and when management and accountants who ought to be playing different roles, namely one is playing an advocate's role, trying to win as a business, and the other should be playing a referee role. When they start playing the same roles together on the same side, bad things happen. But Staubas talks in the second column on page 339 about this, saying that a better alignment, this is halfway down the page, of the interests of auditors and the investing public would be desirable. An arrangement that would permit auditors to feel the benefits to investors from informative financial reporting. Okay, auditors need more contact with and understanding of investors' needs. Of course, auditors must work with client personnel, so complete lack of influence through those contacts is impossible. But a reduction of that influence might be achieved by the following. Okay, and these are just some of the ideas that Staubas lists for separating management from accountants so that this relationship does not become too chummy. Okay, the first idea is prohibiting contact between the auditing firm and client management on matters pertaining to engaging, compensating, or dismissing the auditor. The second idea is prohibiting gifts in either direction between auditors and client personnel. The third is prohibiting auditors from participating in political activities. The fourth is prohibiting auditing firms from providing other services to audit clients, right? So they need to just provide auditing services and not do other things as well. Again, requiring that independent directors or a specialized committee of shareholders represent the latter in all contact with auditors. And then the last idea that Staubas has is requiring rotation of audit firms about every 3 years or so. The idea being that if audit firms rotate every 3 years, then they don't come to see themselves as permanently aligned with the interests of management. All of these problems that Staubus highlights throughout the article arise from the fundamental problem, which is that management pays auditors. But since nothing seems to be able to be done about that fundamental problem, and after all, the auditors need to get paid somehow, and there are good things that come out of management paying auditors. Okay, so when you make the auditing system in financial reporting something that is beholden to capitalist marketplace influences, like the contract goes to the company that is best able to audit, best able to do the job, the accounting firm that's best able to do that, rather than the contract being decided on the basis of some other criterion than market forces. Okay, that's a good thing. That actually creates efficiencies in the system, and it's a good thing for the system to have that set up. But nevertheless, since this is the case, we are going to have, for the foreseeable future, all sorts of problems that will continue to arise in certain management-auditor relationships. Not all, but certainly in some management-auditor relationships, there will continue to be cases where auditors were influenced by the payment management was giving them to see things a particular way and altered their own professionalism and trustworthiness in order to paint a picture of management's finances the way management wanted them to do. Okay, that will continue to happen. All right, let me pause at the end of this. We're about to get into the Enron case. Are there any questions or comments about any of the stuff I've been saying about accounting ethics so far? If everybody's still awake. I've kind of been droning a little bit, I think. Okay, everybody cool? Let's go ahead and start talking about Enron. Okay, let me first of all give you guys an overview of the Enron case with a PowerPoint, and then I will start getting into the nuts and bolts of what precisely was going on and the ways in which the accounting relationship that I've put up here on the board brought about kind of an exacerbation of the whole scandal that occurred as Enron brought Arthur Andersen, its accounting firm, in on it as they went down. Give me just a minute to load this and we'll get going. No input is detected, but I've got it hooked up. Thanks for your patience. Online people, I'm stopping your video while Okay, let's start with the background slide. Enron was founded by Kenneth Lay after merging Houston Natural Gas and InterNorth. Several years later, sorry for the typo, Jeffrey Skilling was hired as president and COO. Throughout the late 1990s, Enron was considered one of the country's most innovative companies. Okay, Enron was one of the largest integrated natural gas and electricity companies in the world. It marketed natural gas liquids worldwide and operated one of the largest natural gas transmission systems in the world, totaling more than 36,000 miles. Okay, if you know your oil and gas companies, you know that there are basically three kinds of companies. There are upstream companies, midstream companies, and downstream companies. The upstream companies are the drillers. They drill in the Permian and the Eagle Ford. They're a midstream or off the coast in the Gulf or something like that. The midstream companies are the pipeline operators. They transmit the raw materials, the raw crude or the raw natural gas to the downstream companies. And the downstream companies are the refiners. Those are the enormous complexes in East Houston. We have actually the largest refineries in the world here in the Houston area. This is ground zero for the oil and gas industry in the Western Hemisphere. And certainly Enron was at the center of that. Enron was a midstream company primarily. Midstream companies are kind of boring companies. They're like toll booth operators. The pipeline companies just charge a fee, and they don't really ever strike it big because that's what the upstream companies, the drillers, do. And they don't really have network opportunities to expand the business like the refiners do into plastics or gasoline or some other in-state product. They're just kind of a midstream company. Okay, but Enron aspired to something more. They wanted to be something more than just a midstream company, because midstream companies aren't especially sexy. They're good earners, regular, steady income earners, but they're not real sexy companies. Okay, Enron was also, moving on to the next background slide, one of the largest independent developers and producers of electricity in the world, serving both industrial and emerging markets. So one of the things that they got into, especially in the late 1990s, was the electricity market, because that was seen as a bit sexier. Okay, after they went bankrupt and all their internal emails got spilled out into the general purpose public square, we got to see for the first time from the inside what they actually were thinking when they were charging rates during various different blackouts and brownouts over the years. And sure enough, what everybody suspected was actually right. Enron was largely responsible for the state of California's energy woes, blackouts and brownouts throughout the 1990s and early aughts. What's that?
What's a brownout?
A brownout, so blackout is no electricity at all. Brownout is limited access to electricity. Yeah. They were very, apparently, like, they regularly joked about squeezing Grandma Millie and other various jokes about making the Californians all pay. So apparently they were really trying to abuse their position, it turns out. Okay, but moving on to the next slide, after a surge of growth in the early 1990s, the company ran into difficulties. The magnitude of Enron's losses was hidden from stockholders. The company folded after a failed merger deal with Dynegy Incorporated. In 2001, Enron's $63 billion in assets made it, at the time, the largest corporate bankruptcy in American history. Next slide. The major players were the CEO, Kenneth Lay, the COO, Jeffrey Skilling, David Duncan, and Sharon Watkins. Kenneth Lay, the CEO, was a pillar of the Houston community. He got up and gave a press conference shortly before the end where he assured the public that Enron's financials had never been sounder. And that very day, actually, he dumped his entire stock holdings in Enron. Okay, secretly. This came out later. He was a member of First Methodist Church here in Houston, gave extensively to support local charitable causes, local church causes. My pastor was once upon a time Ken Lay's Sunday school teacher. Okay, he knew nothing about the Enron scandal, so there's that. But Ken Lay was apparently a regular Sunday school attender, sitting there in the pews and doing dastardly deeds at Enron. Okay, Jeff Skilling, the former Enron CEO, and he was originally hired as the COO. He was kind of the driving force behind it all, who masterminded it. Kenneth Lay just went along with it, but Skilling is the one who came up with the scandal, the ideas that led to the scandal. At bottom, what the Enron case is about is this. Enron wanted to be something more than just a midstream operator, so they wanted to grow quickly. And to grow quickly, they needed financing. They needed to borrow money. But they knew that if they borrowed a whole bunch of money, then the banks were going to get wary, and they were going to give them lesser credit terms that weren't as good. Okay, and Enron wanted good credit terms. And so what they did is they pretended that their asset base was bigger than it actually was. They used a bunch of accounting tricks to try to pretend that the assets that they were using to secure their loans were actually much more substantial than they in fact were. And this obtained for them better credit terms, better financing terms than they would otherwise get, providing them with cheaper money so as to expand their operations. It all worked well until the recession hit and their operations couldn't expand anymore. Okay, David Duncan was the chief accountant involved in this, and Sharon Watkins is the hero in all of this. She was the whistleblower who went public with what she was aware of at the company. I was talking to Mike Creighton. He thinks he might be able to get her here to talk on campus sometime, although probably not this semester. She goes around and gives speeches here in Houston and elsewhere, although I don't know if he can. Her speaking fee's kind of high. We'll see. Mike thinks he can. Okay, moving on to the next slide about the scandal. On December 2nd, 2001, Enron declared bankruptcy. Thousands of people were thrown out of work, and thousands of investors, including most of the company's employees, lost billions of dollars as Enron's shares shrank to penny stock levels. Okay, the company's stock went from, I think, like $70 a share to like 23 cents a share or something in about 30 minutes in after-hours trading. It's good reason not to put all your eggs in one basket. Okay, throughout January 2002, revelations poured forth from Enron, tales of shredded documents, stories of Enron execs seeking help from top government officials, allegations that company officials willfully ignored internal warnings about the accounting irregularities, even as they pocketed millions of dollars in stock market gains. Okay, critics say that government deregulation of the energy business is what created the environment for Enron to fail. The Texas energy business became deregulated in the 1990s, meaning that it became more of an open market and less of a government-controlled field. Okay, that actually contributed in part to the power outages that we had over the last couple months during the Great Freeze, was because of the deregulated Texas energy market. It's great and more efficient during normal times, but during abnormal times like the big freeze, it can lead to incredibly high energy prices because that's what the market dictates. I mean, that's what it costs to obtain energy when it's that scarce. And this can create lots of problems. Okay? But on the whole, it's been good for Texas, I think. Chairman and CEO Kenneth Lay had long taken part in U.S. Vice President Dick Cheney's task force on energy policy, which met behind closed doors. Enron executives, particularly Lay, were chummy with many in the U.S. presidential administration, including President Bush himself, who referred to his friend Lay as Kenny Boy. Okay, so the Enron execs were very highly connected with U.S. and state government officials, including especially with many officials in the Bush administration. Although, to my knowledge, no one in the Bush administration was actually implicated in the corporate scandal. Moving on to the next slide, the impacts of the Enron collapse spread out in many directions, starting with Enron employees who lost their jobs, shareholders who saw their investments shrink to a fraction of their previous value, energy purchasers whose contracts were not delivered on time, and insurance and financial institutions and other creditors who held the bag for $11 billion of unsecured debt, which was the amount outstanding when the company went down. How it happens? Well, the centerpiece of this was accounting fraud. And I'm going to talk about the accounting fraud in a little bit of detail in a minute. But the two things that I want to highlight here on this slide are mark-to-market accounting, an aggressive use of this, in particular an aggressive way of tabulating company assets, and also the use of special purpose entities, which was a creative way of hiding company debt loads. Okay, as a result of the Enron scandal, the biggest corporate scandal in American history, we had immediately following Enron the passage in the United States of the Sarbanes-Oxley Act, which was the largest piece of corporate legislation in American history. Okay, and again, a reason for us to be proud of our fair city. Okay, the Sarbanes-Oxley Act is something I'm sure you've heard of in your other classes. It's a very large, sweeping piece of regulatory legislation. Okay, and it was intended to cut down on the incidence of corporate fraud, just like what happened in the Enron case. Protecting investors by improving the accuracy and reliability of corporate disclosures, closing various loopholes in accounting practices, strengthening corporate governance rules, increasing accountability and disclosure requirements, and so forth, as well as strengthening whistleblower protections. Okay, those are the basics. I want to get into some of the nuts and bolts of the Enron scandal in the balance of our time today. Let me stop and ask if there are questions or comments so far. Did anybody here have relatives or friends who worked at Enron? Okay, often many HBU students have that in their background. It was a very large presence in Houston. Minute Maid Park, where the Astros play, was once Enron Field. If you looked downtown, one of the first things that people noticed was the gigantic E above the Enron building in the downtown skyline. Enron had its name on all sorts of things around the city. Okay, they had a large presence, corporate presence in the Galleria area. The executives, many of them came from the Houston area or lived in the Houston area for a long time. It's a real sad story because when you look at it in detail, you think to yourself, what the heck were these people thinking? At the very end, I think they weren't thinking. I think what they were just trying to do was keep the music going for another couple weeks. And so they just kept adding more debt and more debt in order to pay the interest on previous debt. And in the end, several people actually committed suicide. Ken Lay died in jail, probably of stress-related heart. He had heart disease, but it was probably stress-related trigger as he was facing trial. Others went to prison. It was a very sad story. One dude committed suicide just down the road here in a park. Okay, let's look at the nuts and bolts of how Enron did it using some accounting tricks and devices. And I want to talk a little bit about accounting ethics as I mentioned this. Okay, so whenever you borrow money, like for a house loan, a mortgage, or for a car loan, or for a personal loan, like a credit card loan or something like that, whenever you borrow money, you do so at a particular interest rate. And your interest rate varies in accordance with how confident the bank is that they will obtain, that they will be able to recover the money in the event of a default. Okay, an unsecured loan usually has the highest possible interest rate. If you look on your credit card statement, it will tell you the interest rate that you pay on money that you carry over each month. Okay, what are some sample interest rates that you see when you look at credit card statements? 12 is pretty low. 26 is more reasonable, or more normal, I should say. Okay, they're pretty high interest rates. Okay, quite high actually, as far as those things go. And the reason why is because credit card loans are known as unsecured loans. These are unsecured loans that you get just because the bank has looked at your credit history and thinks that you are a worthy borrower that they're willing to trust. But still, you get a higher interest rate because there's no security, no collateral with the bank.
Does that interest only come in if you don't pay it off every month?
That's correct, yes. If you're a revolver, meaning you hold a revolving balance each month, then you're going to be paying whatever that interest rate is on your card. But if you're, like my wife and I pay it off each month, we used to have travel cards where we'd get travel points, but that was pre-COVID. Now we just rely on cash cards. And the credit card companies don't like us at all because we pay it off each month and we make 1 to 2%, depending on the credit card, cash back every transaction. So it's actually a system where the prudent people financially are able to mooch off of the imprudent ones, because the imprudent ones who do pay that 26% each month are the ones who subsidize my wife and me as we make 1 to 2% on all of our purchases because of the credit system. Okay, it's a kind of a predatory system that way. But I mean, I don't feel bad about participating in that system because certainly I'm just a recipient. They are offering me the money, and I don't think that I'm actually actively exploiting anybody in participating in the system. Okay, but in the world of business, there are different levels of trustworthiness in borrowers. Okay, at the very top, the best of the best, like Apple or something like that, they get a AAA credit rating. This means a credit rating where they're seen as very, 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 very likely to repay the money. And they can borrow for very low rates. Okay, and that's on both their secure and unsecured loans. That credit rating, corporate credit rating, is given out by rating agencies like Fitch's or Standard & Poor's or Moody's. Those are rating agencies. And that credit rating enables them to borrow for very, very low rates. Okay, that can then descend down the loan book to junk bond, all the way down to junk bond status. Okay, all the way down to C or lower. And when companies get a particular credit rating based on an independent evaluative process from the ratings agencies, this actually determines, it substantially impacts their borrowing abilities. Okay, so it is in the interests of companies to get a better credit rating, just like it is in your interests to get a better personal credit score in order to obtain better financing terms. The first thing that banks look at when you take out attempt to take out a mortgage is they look at your personal credit score. Okay, and for that reason, it's always a good idea to start building a credit history now, because that actually helps increase your credit score over time. Okay, build a credit history now and be responsible paying off your bill each month, and your credit score over time will gradually accumulate. Okay, Enron wanted to borrow money, and they wanted to borrow a lot of money so they could expand their operations. But the more you lever up, the more that damages your credit rating as a business. So they wanted to pretend that they weren't as levered up as they actually were. They wanted to hide the amount of money that they in fact were borrowing. And they used two different accounting techniques primarily in order to do this. Okay, so they wanted to pretend that they were higher up on that credit book than they actually were. One was an aggressive use of mark-to-market accounting. Mark-to-market accounting is a standard procedure in a lot of accounting operations. When you take an asset and you put it on your balance sheet, it is standard procedure to list it on the balance sheet for what it would fetch on the market now, as opposed to, say, what you originally purchased it for. Okay, so one thing, once you guys go out and buy cars, maybe some of you have already bought cars, one thing that you will often hear is that if you buy a new car, it loses $2,000 as soon as you drive it off the lot. And that's actually true. You should never buy a new car. Never. Always make sure it's at least 6 months old, okay, or a year old. And you will save yourself thousands of dollars in the course of your lifetime. Your car, maybe you have one right now, your car on your personal balance sheet should be listed for what it would currently fetch on the market, not for what you purchased it for. Okay, because it probably wouldn't fetch that much. It's a depreciating asset. Your home, by contrast, is an appreciating asset. Homes don't lose value over time, generally speaking. They tend to accumulate value, substantial value, actually. Okay, mark-to-market simply lists assets on a balance sheet in accordance with what they could currently fetch on the open market. And that's a standard operating procedure. But Enron's use of mark-to-market accounting was very aggressive. What they would do is they would purchase a particular plot of land with a certain amount of oil or natural gas deposits. And then they would actually inflate the value of the assets there, pretending that more had been discovered than had really been discovered, so that the assets would seem more valuable come lending time, so that it would look as though they had more collateral for the lenders. Okay, I neglected to mention a minute ago, credit cards are personal loans without collateral. That's why they have the high interest rate. But also there are other kinds of loans, personal loans, that you can take out that have collateral that have much lower interest rates. Okay, home loans, for instance, mortgages have much lower interest rates than credit card loans because they are secured. They're considered secure loans. The security is the home. which can be repossessed by the lender. Car loans are much lower interest rates than credit cards, et cetera, et cetera. Enron was using these assets in order to secure the loans that it was obtaining from financiers, and it pretended its asset base was much larger than it in fact was. Okay, let's look at the second thing that they did. So it was mark-to-market accounting in an aggressive way. Abnormal mark-to-market accounting is the way we could characterize it. The second thing they did was they used special purpose entities. So pretend that this is Enron, the entity that publishes its financial results multiple times a year, a publicly traded entity, and the public is they're given access to Enron's finances through their 10Ks, their 10Qs, various other public forms that they publish each year. Okay, so that's Enron. Enron also, though, set up other entities. Okay, SPEs, I think they set up like 65 of them. Special purpose entities that were officially listed as being different than Enron itself. And they loaded up these SPEs, they were all dependent on Enron, but they loaded up these SPEs with toxic amounts of debt. And it was all done in a network of interdependent relationships. But when the public looked at Enron's books, all they saw was a much smaller amount of debt than in fact was being carried. Because Enron did not reveal to the public the amount of debt that they had offloaded onto their special purpose entities, all 65 of them. There's a way of hiding debt and a way of pretending, especially to lenders, that the amount of debt that Enron was carrying was not in fact as great as it really was. This is because, of course, the more levered up you are personally, the more the bank worries about your ability to repay your loan, and the more levered up Enron or any other company is, the more their financiers worry about their ability to repay their loans. Okay, so this again was just to pretend that the debt was smaller and that the asset base was larger than in fact was the case. Let me pause and ask if there are questions or comments so far.
I have a question.
Yes, Diana.
I understand that the SPEs are created substitutes.
Special purpose entities.
Sorry, yeah. So I understand that they're created dependent off of Enron.
Mm-hmm.
But what are these?
Officially, they were. So, do you know what an entity is?
No.
Oh, okay, for sure. Good. That's cool. So, if you wanted to say to start a partnership, a business partnership, the best way to go about doing that is to make it formal and recognized by the government by starting an entity. Okay, and this could be a mutual partnership where you and your business partner share all assets and liabilities together. It could be some sort of a dependent partnership. For instance, I think I still am listed in my dad has set up a corporate entity. He owns a small dental office. And I think I'm still listed actually as a board member in his corporate entity. Okay, I am a dependent or general partner, not a, I'm sorry, I am I am a restricted partner, I believe. I'm a limited partner. I'm a limited partner in his corporate entity, not a general partner, I apologize. He's the general partner. A general partner is someone who is responsible for all potential liabilities. A limited partner is only responsible for a restricted amount, and beyond that can't be touched legally. Okay, so there are some entities that are set up hierarchically like that. Others are set up mutually. Whenever you enter into business with somebody, some sort of a business arrangement where you are doing business with someone as a partner, it's typically set up as an entity. You want to set it up as an entity so you get certain tax benefits and the government recognizes you. companies are set up as entities as well. That's just what they are. A corporation is just a certain kind of entity. And Enron is set up as an entity. It was an entity with an executive team and an independent board of directors. That was the way it was set up structurally. And each of these special purpose entities were set up as different companies, but they were actually interdependent upon each other and upon Enron in ways that made the debt something that Enron, in fact, was itself carrying. Okay. Yeah, I'm so sorry, guys, if I was just assuming throughout this whole discussion that everybody knew what entities were. Take legal environment of business if you get a chance. It's a way for to learn about the details of setting up entities and partnerships and things like that. Okay, other questions? Okay, like I said, towards the end of the Enron case, it became pretty wild, especially in the last year or two. I don't really know what people think in a situation like that, but I think what happens is they just try to keep things going. Okay, and I actually want to illustrate this. I want to finish the lecture illustrating this with a particular illustration from nature, because this is the best way to understand the Enron case, in my opinion. I think it was a phenomenon of mass psychology. We're going to talk more about the nuts and bolts next time, but right now I want to talk to end today about the psychological phenomenon of Enron. Okay. Here's what I want us to think about as we think about the psychology behind why Enron occurred. If you look in nature, sometimes you can see animal behaviors that are really bizarre. Okay, one animal that's got a reputation for bizarre behaviors is the lemming. Anybody ever heard of lemmings? Okay, a lemming is a small prairie dog-like animal. Okay, and lemmings are normally just typical prairie dog animals. I guess they eat, what do they eat? Grubs, worms, insects? Who knows? Okay. But lemmings have this crazy reputation because every once in a while, biologists think that it's when lemmings in population size become overpopulated in a particular area. But every once in a while, lemmings will just start running together. Okay, maybe one lemming starts and others join him. And they all start running in a certain direction. And more lemmings join in. And more and more and more lemmings join in. Until finally, sometimes thousands or tens of thousands of lemmings are all simultaneously stampeding across the countryside together, over obstacles, around trees, over bushes, over rocks. It doesn't matter what's in their way. They all stampede together. And what will happen is they will come to a body of water. They'll come to a lake or an ocean, and the lemmings will plunge themselves in. And they will commit suicide en masse. Tens of thousands of them all at once. The lemming is known as the suicide animal. And it's really bizarre behavior. The biologists think that it's some sort of phenomenon that happens when overpopulation has occurred. But if you think about it from the perspective of individual lemmings, each individual lemming, I'm sure, doesn't intend to commit suicide. I mean, I really doubt it. Probably what each individual lemming is doing is looking around himself, seeing other lemmings just sort of running forward, and each individual lemming decides for himself, well, I guess that's what I'll do too, because that's what everybody else is doing. And together, in the thousands, this creates a crazy psychological event where all of them are doing the same suicidal thing because the others are doing it. And that's the explanation at bottom, is just that others are doing it as well. And I think that's the only way you can explain the choices of the hundreds of people at the top of Enron who all were involved in this and knew that this is what was going on. and that it was all a sham. They probably were involved in this because others were involved in it as well. And maybe they felt safety in group numbers. Maybe they were like the lemmings and they just looked to their right and to their left and saw other people doing the same thing. Whatever the explanation, I think this is the key to understanding psychologically why Enron occurred. Just like with the lemmings, the Enron execs, most of them at least, maybe with the exception of a few leaders, they did what they did because that's what was being done in their workplace. That's just what was being done. And they probably didn't think twice about it or thought very little about it and comforted themselves with the fact that so many others were doing it at the same time. Okay, I think that that's the explanation at the end of the day for this crazy group phenomenon that was Enron. We'll talk more about the nuts and bolts of the Enron case next time, including especially an investigation into the role of Sharon Watkins as the whistleblower and some other kinds of accounting specifics. But for now, I will leave you guys with that psychological note. Okay, I'd like to show you guys a video of lemmings. You can see it on YouTube plunging off a cliff. Okay, you can look it up if you want. Yeah, that's exactly the video, yeah. So like the lemmings like surge forward over the cliff and then like plunge off into the ocean. But I can't, my projector's not working, so you'll have to save it for another time. You'll have to imagine little prairie dogs running off a cliff and plunging into the ocean.
Almost like hamsters.
Yeah, sort of like hamsters. They just sort of like fly over the cliff and plunge themselves in.
It shows them swimming in the water, so.
Well, they then, like some of them survive and swim until they drown. So they just like keep going because that's what all the other lemmings are doing.